guys. I'm back again. So my name is Maurya Hanspal, and this session is to talk about some of the most important topics and parameters in financial modeling that a person who is creating the financial model need to understand. So this session is something that won't be telling you ideally how to create that financial model, but is for someone who knows how to create the financial model and how to handle the different nuances, right? I agree for a few of the people who might be watching this video, a few of the terminologies or a few of the concepts which I might discuss might be too basic or too easy. Whereas for a few of the people who might be into this industry, right, or want to plan to join into this industry, these topics might be very difficult or complicated to understand, right? So both the sets of topics I'll be trying to discuss here, the easier topics, the easier conceptual topics, and the most difficult, tricky, and complicated topics as well. Correct? So both the aspects shall be covered here. And a few of the topics which you guys believe are important to be discussed in much more depth manner or a much more intricate manner. I've already uploaded a few of my sessions on YouTube already, like with regards to financial modeling. Also, I'll be uploading certain sessions on financial modeling in future to make you understand certain things. And also, I run my own course on investment banking, which tells you clearly about the different aspects of financial modeling and valuation, from the very basic to the most advanced level, practically. So everything into that curriculum is being taught practically. And so that is one thing. So this session is won't be an in-depth understanding. It would be an overview. I'll be telling you in very simple language about the different nuances and intricacies of financial modeling and valuations and different parameters you guys need to take into consideration. Because I'm trying to keep this session very general for everyone, those who have the knowledge of financial modeling and those who have some limited knowledge but planning to build up a career in financial modeling, right? And various in-depth sessions can be scheduled later about all the intricacies and nuances. So one thing is that the first topic I will just begin with a minute discussion upon the discounted cash flow analysis. So we know that what is the DCF modeling? Like when we talk about the discounted cash flow analysis, it gives us the intrinsic value of a particular stock or a company or the fair value of a company. So how the process works? Firstly, we try to forecast the future cash flows of the company. We can forecast the free cash flow to the firm or free cash flow to equity by having a specific formula, taking into considerations your earnings before interest and tax, adding back your depreciation and the amortization expenses, right? And then you are subtracting your capex and the change in working capital needs in case of the free cash flow to firm. But when you have your free cash flow to equity, you also take into account your change in net debt, right? So not going towards the formulas, but keeping this session very general for everyone. Our first step we all know is to forecast the future cash flows by using specific formulas. So when we calculate or forecast the future cash flows, be it free cash flow to firm, FCFF, or free cash flow to equity, then we tend to discount these cash flows by a certain discount rate. If is the free cash flow to firm, we tend to discount it by the total cost of capital or the weighted average cost of capital, WACC, or simply we call it as the discount rate. Because free cash flow to firm is something which is available to all the capital providers of the firm, be it the debt holders as well as the equity holders. That cash flow is available to all the capital providers. And that is why we are discounting it by the discount rate. And that total discount rate incorporates both the cost of equity and cost of debt, because ultimately that's the cash flow being available to all the capital providers, right? And we calculate the weighted average cost of capital by taking into consideration the cost of debt into the weight of debt plus cost of equity into weight of equity. And simply we tend to calculate the cost of capital. There can be various other multiple ways as well to calculate that. So that we'll discuss sometime later. Also, when we are using FCFE, that is free cash flow to equity instead of free cash flow to firm, we're discounting it by what? The cost of equity and not the overall cost of capital. Because FCFE is the cash flow which is available only to the equity capital providers, only to the equity holders and not the debt holders. So it makes no sense to discount that FCFE component with the cost of debt or the overall cost of capital. It's just discounted by the cost of equity. FCFE, very popularly used in the valuations of the BFSI space, especially the banking sector, right? Because there we tend to calculate FCFE and not FCFF, and there are multiple reasons for that. I've already discussed that through my multiple YouTube videos and LinkedIn sessions, right? And further going on towards the second method of valuation. So that is your relative valuation method. I believe that this method of the relative valuation is not about valuation. It's more about pricing a company, because you are taking some standard multiple or average multiple of a similar company within the same industry, or the average multiple of that particular sector or industry, and trying to calculate the price of your company, right? That's ultimately pricing. It's not your intrinsic value or the fair valuation. Though I do use this method of relative valuation, but in most of the scenarios where the cash flows are there, earnings are positive, I try to utilize the DCF method, because that gives me a closer point, or a closer point towards the exact valuation of the company. Now, I completely agree that my valuation numbers or forecasted multiples might be different from some other guy, right? I completely agree to that, because I might have some different assumptions. The other guy might have some different assumptions, but I need to back my assumptions. If I'm not able to back my financial model with assumptions, then I am completely wrong. I need to be confident on my assumptions. I need to be confident on my numbers. You might have heard different people from different organizations talking about on various news channels, be it CNBC, be it Z Business, be it NDTV Finance. They try to give about different forward multiples. Some analysts tend to say that this company will trade at a 2x forward multiple FY25, or this particular company will be trading at a 3x forward multiple. Some people tend to consider that company as overvalued. Some people tend to consider that company as undervalued. Some people tend to consider that company as fairly valued, because different people have different assumptions and ways of calculating. All those inputs which are being used to create the financial model are being used in different ways, right? And different people are using those inputs, having different assumptions at the back end. And that needs to be clear. So not to worry about that. If your financial modeling numbers or forecasted valuation multiples are different from some other person's financial model or forecasted valuation multiples. So that thing we need to be very well clear about. I believe DCF modeling is more of valuing a company, calculating the fair value, intrinsic value of a company, and relative valuation is more of pricing a company. So not wasting any time, coming back to the other fewer topics, and I'll be trying to cover that topics very quickly in an overview manner. And I'm happy to discuss those topics in great detail in my further sessions and through my live training curriculum as well. People ask me that how do we identify an undervalued company or an undervalued stock, right? Ideally, the parameters which need to be taken into consideration is the company should be trading at a lower price to earning multiple, a lower price to book value multiple. The earnings of the company should be very strong. I've just mentioned my points here as well. I believe the company should be trading at a low price to earning multiple or a low price to book value multiple. Now, here there are some nuances. Some companies use price to book value. Some companies use the price to earning. For banking spaces, we prefer price to book value. For asset intensive space, we prefer the price to book value. And for the other type of companies, price to earning is also beneficial. The price to earning can be used for all the companies in general as well, but there's a difference between these two multiples, ideally, right? So without wasting any time, going to the second point, the company should have a higher growth rate. The company is commanding a lower price to earning multiple or a price to book value multiple, but the company should command a higher growth rate. The riskiness of the company should be less. The risk possessed may be in the cash flows, the debt structure, the future forecasting, the capital structure, or any kind of parameters that you take into consideration. Bankruptcy parameter, the auditing parameter, the auditing standards parameter, कि company में कुछ fraud तो नहीं हो रहा. So all these things need to be taken into consideration. Company specific risk, sector specific risk, economy risk, global risk. How much is the risk possessed into that particular company? Ideally, it should be low. Then the company should have a higher return on equity or return on capital employed. The company should have a higher ROE. Now, here people might argue that when will the company have a higher ROE? It can happen when the base is also too less. It might happen the company is not going for some capital expenditures, for some diversification activities, right, to expand its businesses, right? Because the businesses that are going for expansion and diversification would also have a higher growth rate, right? And that might conflict with this point. Completely agreed. Completely agreed. Even if, because ultimately all these investments like which are being made into these projects might have a longer gestation period. And the investors might not be able to reap profits in just some minimal years. It might take 5 to 10 years to reap that profits, right? So in general, I look into the ROE of the company should be high, but also along with that, I take into consideration other parameters. I just don't look into these parameters blindly. That if the company is having a lower price to earning ratio, then I should buy that company. Or if a company is having a higher price to earning ratio, then I should sell that company. Even a lower price to earning multiple company can be bad. It might happen the company is a penny stock. The company's fundamentals have worsened. The company has gone bankrupt and the company is trading at a very lower multiple. Then why would you even buy that lower penny stock? It makes no sense. Also, on the other hand, it might happen the company is trading at a very high valuation, excessive high valuations, price to earning multiple. But the fundamentals of the company are supportive. The earnings are supportive. The structure, the capital structure is supportive. The management commentary is supportive. In that case, why would I even sell off my overvalued stock? I might think of holding it, or I might even buy it more. And similarly, growth factor is something which I don't compromise upon. Riskiness, it might even happen the company is a high risk company because the high growth might also come with a higher risk. So even if the risk is high and the stock is undervalued, having a higher growth rate, I might even purchase that stock. Higher ROE, even a lower ROE for a certain period of time. If I believe the company is going for some good expansion projects and that will take a good gestation period, and the company might deliver me that ROE after 5 to 10 years from now, I'm fine with that. So even a lower ROE, but justified with that capital base is very important. Justifying that lower ROE with that capital base. If a lower ROE is not getting justified with that capital base, again, I might not purchase that company. And also, there is a good relationship between the ROE and price to book value. A higher price to book value company might have a greater ROE and vice versa. Why? So that's a matter of a separate discussion. We work through various kinds of regression tools and kinds of derivations to analyze this relationship. So that's not the part of this discussion. Okay. A high growth company might pay you a high dividend also, but not always. So this thing we need to take into consideration. So that is one analysis. Also during valuations, if I just take a separate page and insert a blank page, some people during the valuation, they also tend to argue that whenever we are calculating the risk-free rate, because in the valuation, calculating the risk-free rate is very crucial. Calculating the cost of capital is also very crucial. Calculating what? The growth rate is also very crucial. So how to take that? How to calculate that? So whenever I'm talking about the risk-free rate, right? The one best way is to take the risk-free rate directly from a government website, right? Be it any country, be it you are in India, take the treasury bill rate, a treasury note rate, and like it depends upon the timing of the valuations, correct? For example, if you're doing your valuation for a period of 10 years, then you can't use a treasury bond rate, right? Because they have a time duration of more than 30 years. The majority of those bonds is more than 10 years. Sorry. So like between 10 to 30 years, right? So ideally a treasury note will suffice because that has a maturity between 2 to 10 years. If you're doing just a valuation of just 5 years, a treasury note bill will suffice. The risk-free rate on a treasury note bill will suffice. In that case, it's not beneficial to take a risk-free rate on a treasury bond. So that thing we need to be very well understood about. That consistency must be there. That duration should match. That maturity period should match. So that is something that we must be very well aware about. Some people, they also tend to calculate your adjusted risk-free rate. Now, there can be multiple methods, like which you guys might also know about calculating these things. I'm just discussing a few of the methods. If we talk about the risk-free rate, they tend to calculate an adjusted risk-free rate, where they tend to subtract your default risk of a particular country, right? For example, if the risk-free rate in India for a treasury note is 6.5%, they will tend to subtract the default spread of maybe 2%, right? So what basically happens in that case, you might have a risk-free rate of 4.5%, right? So subtracting the default spread. How to calculate that default spread is again a matter of question. There are multiple ways to calculate the default spread. Sometimes what people do, they tend to take the interest rate on an emerging market bond minus the interest rate on a US bond. And they tend to take it as your default spread. That component becomes your 2%. Whereas there can be multiple ways. Various government websites and top financial institutions also give country-wise default spread to you, which you can adjust to this rate. Sometimes they also take into account an inflation component. And for example, and ideally they tend to compare all the countries with US. because USD being the reserve currency and US being the largest economy. Though that is debatable, but ideally till this point of time, they are using this method. They tend to use a 1+ risk-free rate of US, the current risk-free rate in US. Then they tend to take into consideration 1+ inflation rate in a foreign currency and 1+ inflation rate in US. That's it. They tend to take the risk-free rate in US, 1+ the risk-free rate in US, plus the 1+ the rate of inflation in some other country, divided by, for example, if you're doing the valuation in India or Brazil. So take 1+ risk-free rate of US into 1+ the inflation rate of India or Brazil, divided by 1+ inflation rate of US. And here also you tend to get the risk-free rate. So one way to calculate that. So there can be multiple ways. Some people tend to argue this method and they tend to deny this method, but I believe that this method is also more appropriate because it's taking into consideration inflation rate. Because the main goal of investor is to beat your inflation, be it going towards a risk-free bond or like going towards equity. They want to beat inflation, right? Inflation to beat karna is the main goal, right? But both the methods are fine. They might give you some different values, but the final valuation modeling might be closer or it might be different because like different parameters are also taken into consideration. It's not just like one parameter. And when we add your inflation plus the real growth rate in the economy, inflation plus the real growth rate or the real GDP rate, we get your intrinsic risk-free rate in the economy. Adding inflation plus real GDP rate or real growth rate, we get that intrinsic or fair value risk-free rate that should be prevailing in the economy. In US, ideally, they tend to calculate something which is called as R star. That's an equilibrium risk-free rate when the economy is working fine. And they tend to compare the current risk-free rate with that R star. That what's the gap and where is the economy going in currently. So that is my opinion or my definition for risk-free rate. We can discuss further into that. Deep dive can also be done, but keeping the limited time that we have, I'm just giving you an overview about what all kinds of notes and valuations, all those kinds of notes which I have made for myself, right? Because you guys should also benefit. Then we have the risk premium, right? The simplest method to calculate the risk premium, as we all know it, is what? By taking the difference between what? The market equity return, the return that you get on an index minus the risk-free rate, right? So that gives you an equity risk premium. Now there can be multiple other ways to calculate that risk premium, correct? So what can be the multiple other ways to calculate the risk premium? Because this method that we calculate is on the basis of historical market returns and historical risk-free rate. These are not the current market returns or the current risk-free rate, ideally, correct? The risk-free rate might be current in most of the scenarios, but the market rate that we're taking into consideration is the historical performance of the market over the past average time period. But the problem is the historical risk premiums. We tend to call them as historical risk premiums. So these historical risk premiums can be noisy, right? They might have a standard error of more than 2. Now, what is standard error is a matter of separate discussion, right? Separate sessions are there for that. So ideally, they're more noisy, more volatile, and they have a standard error of more than 2, right? So ideally, what people tend to do, they calculate your equity risk premium. So you have the value of the equity risk premium, just assuming that the value of the equity risk premium is 2. They tend to add the country risk premium or a sector risk premium to it, right? So tend to add the market risk premium or a country risk premium, assuming the country risk premium to be 4, right? So 2 plus 4 becomes 6. So 6 becomes your equity risk premium. Though in colleges, in most curriculums, we tend to learn that the equity risk premium is just the difference between the market rate of return minus the risk-free rate. And taking the risk-free rate like just from the government website. But there are ways to calculate the risk-free rate, which people are doing in the real life. Because again, we need to be more accurate, we need to be more precise while calculating these numbers of risk-free rate or equity risk premium or market risk premium, because ultimately these numbers become inputs in your valuation model, right? And you have to publish these numbers. So adding your equity risk premium, so again, this number is again historical number, correct? And adding the current country risk premium or the market risk premium to it. Again, all these numbers of country risk premium are available on various government websites and SEBI sites on different institutions also provide you this number. Just simply type on Google the country risk premiums of a particular country. You might find the list of all the countries and having the country risk premium, right? Other way where people tend to calculate is that they tend to take the S&P risk premium. S&P ka risk premium they tend to take. Again, why? Because USD being the reserve currency and all these economies being compared against US. Again, the matter of debate, but that is the stance in the current world. They take the current market risk premium of the S&P, right, in US. And what do? They add a scaling factor and they multiply this scaling factor by what? By the default spread. By the default spread. Uh, just a second. My screen should be visible. Yeah, I'm back again. Yeah. So they're having this like this S&P equity risk premium, and then adding plus to the scaling factor. I'll just scroll it up. Yeah. So this S&P risk premium, and then adding the scaling factor to it and multiplying it by the default spread. How to calculate default spread? We know it already. One simplest way is to take the interest rate on an emerging bond minus the interest rate on a US government bond of same maturity. That will give you the default spread. S&P risk premium, again, that's available on all social media, on all media platforms, plus a scalar factor. So what is the scalar factor? The scalar factor is nothing but it's the standard deviation or the volatility in the returns of the emerging markets equity index divided by the standard deviation or the volatility in the returns of an emerging market bond index. So you are just calculating an index return. For example, in this case, calculating the Nifty 50 returns and taking the standard deviation of that because India being emerging market, taking the Nifty 50 returns over a standard time period and taking the standard deviation of that, dividing that, taking the returns of the Nifty bond index or a bond index which is tracked in India, right? And calculating the standard deviation of those bond returns and dividing the standard deviation of the returns of equity index by the standard deviation of the returns in the bond index. You get the scaling factor. So S&P risk plus that scalar into the default spread. One very popular way which most of the guys are using to calculate for equity risk premium. Very popular method, right? So that is one thing. And if you guys want the notes of all these things, I'll be happy to share the notes. Just give me a ping, right? Other method to calculate your equity risk premium, multiple methods are there, right? So what do? They tend to take something which is called as a lambda approach. Okay, if this is the correct lambda, I don't know how you guys make lambda, but I make lambda such a way. Okay, so this is a lambda approach. So this approach is basically used for specifically those companies who have a huge stake in the national interest, right? The companies whose performance, whose returns, whose exports, imports are linked to the performance of the country, right? Big companies like Tata, Adani, Reliance. Now, these are not stock recommendations, the general companies I'm naming. I have no view on these companies, to be very clear, right? Then also for some companies which use derivatives to hedge their risks, which can be foreign currency risks. It can be a full hedge, a partial hedge, an asset hedge. Now, what are these hedges is a part of separate discussion. But those companies which use derivatives to hedge their risk, right? So specifically for those companies, we tend to use this lambda approach. It is not used mostly, right? But some people have started to use it more practically, right? So what do we do? For example, if a company you have as Reliance, okay, or a company A, because I do not want to land into specific stock names, company A, okay, company A derives 90% of the revenue from India. It's an Indian company. It derives 90% of the revenue from India. Okay. Now have a number, an average Indian company, it derives how much revenue from India? Now this company A, it derives 90% of revenue from India. Have that number that all the companies in India, what's the average rate or what's the average number of the revenue derivation from India? If there are 100 companies in India or 1,000 companies in India, how much percentage of revenue they get from India in an average number, assuming it to be 80. Okay. 80% by 90%. So 90% is something which this company A derives. And average, on an average basis, Indian companies derive 80% of revenues from India. 90 by 80, 9 by 8. So we'll have something as 9 by 8%, right? 1.1% or something, right? So that is something, this 1.1% or something that you are getting is what? Is your equity risk premium, right? This method is not popularly used. It's very rarely used, right? I'm not suggesting you or emphasizing to use this method. You can avoid using this method, but one method is something that you should know about. One again popular method, a more accurate method like which has been starting to use is the YTM method. The YTM method. We know that how to calculate the yield till maturity of a bond. If not, then refer my sessions. YTM. So what do we do? We have the market price of a particular bond and we're discounting those coupon payments, right? By a certain discount rate, correct? 1 plus R something, correct? And when we're discounting these coupon rates by the market rate of return or by the discount rate, we tend to get the market value of the bond. That's the YTD method. And sometimes we have the market value and we have to calculate this R, like which is nothing but YTM. Correct? The vice versa is also true. So what do we do in case of equity? We tend to take an index value, the value of the index. We have it already, Nifty 50, Sensex as of particular date. We'll take the returns. These returns are nothing but the coupon payment. Now Nifty won't be giving you coupon payments. Take the dividend yield or the buyback yield, right? How much Nifty has earned out of dividends and buyback. So that amount can be taken. How to calculate that? It's very simple, very basic. We'll deep dive into some other sessions, but like keeping it very basic, taking all the dividend payments which the Nifty companies have given you and the buyback yields, how much the investor has earned out of buybacks, right? So this will take into consideration, correct? So that becomes your coupon payment and R you have to calculate for different time periods and you have a plus sign in between. So once you calculate this R, like what do you get? You get your R, that is a risk-free rate. Subtracting the risk-free rate from the index return gives you an equity risk premium. Again, that is very beneficial method, a more accurate method. And this is a forward-looking method to calculate an equity risk premium. So that is one thing. So that was about the risk-free rates and the equity risk premium. The last thing I will cover is about growth rates. Again, growth rate is a very important factor because whenever we are trying to forecast the future revenues or we are trying to use that growth rate in the terminal value calculation, it becomes very difficult, right? How to use that growth rate. First example, first thing is coming back to the minor thing, the most basic thing, how to forecast the future revenues of the company. If the revenues are constant, if the revenues are growing by a constant rate, a constant growth model can be used. You can simply use the averages and apply it by at an increasing growth rate. So like use that number of an average and you can increase the previous revenues by the similar amount. So that method is very outdated because not all the companies like will have the constant revenue growth. A more popular method that is used is the first method, as I told you, when the company has a constant revenue growth. In that case, a constant growth method can be used, simply taking the average growth rate and using that growth rate to increase the further revenues. The second one is the earnings of the company might be volatile or they might not be growing at a similar growth rate. In that case, we can use the smoothened approach. We can use a simple moving average, right? I've talked about this in my detailed sessions, a simple moving average SMA to remove those fluctuations. And we can use a simple CAGR method, right? Having the final value divided by the older value, the previous value to the power of 1 by n, the time period minus 1, right? Of these numbers, once we have those smoothed numbers with us while calculating that simple moving average. So out of those smoothed numbers, we can take the final value, the most oldest value from where we have started the discussion from, to the power of 1 minus n, the time period minus 1. Various Other methods are also used. Some people tend to use a log normal approach, right? They have those average growth rate. They tend to use a log function, log into 1 plus growth rate, and then they tend to increase the future revenues with that. Some people just tend to use the average growth rate of the industry. Some people tend to use the average growth rate of the economy. So different types of rates can be used. It's completely upon your understanding, right? But you need to understand management commentary, management guidance, right? Like whatever they have paid, or like whatever they have commented upon that particular stock, because that will change your numbers. Because financial modeling is not just about taking the numbers historically or making your own assumptions. You also have to hear management commentary because that might also change your future forecasting numbers. When we're calculating the terminal value or anything in general, the growth rate, one popular method that is used is the Buffett's method. Like what do they do? They tend to take the ROE into the retention ratio. They assume that you have the return on equity and the retention is something that the firm has kept with itself, right? And this money can be used for expansion, for diversification, for helping investors earn more ROE. Because ROE, just try to remember this point, ROE is a function, right, of the quality of investments and how those investments are funded. I'll repeat, ROE is a function of the quality of the investments and how these investments are funded. Because ultimately, all this amount being retained will generate ROE because that might be used for further expansion, diversification activities. One minus dividend payout ratio, right, is your retention ratio. But there might be a problem when this retention ratio is negative. There are companies where you have this uh, retention ratio as negative, right? It might happen the company has incurred more losses as compared to the profits in the previous year. The ROE might be negative, right? So these scenarios might be there. And then what to do in that case? In that case, ideally, for the reinvestment purposes, right? We tend to use something as your sales to capital ratio, and that's used to calculate your reinvestment, right? Your sales to capital ratio, right? A very popular method. And this method is also being used in calculating for the loss-making companies, in calculating the reinvestment rate for loss-making companies as well. The formula ideally becomes as your delta change in revenue, the change in revenue by what? Your sales to capital ratio. It tells you nothing but how much sales the company is able to generate for a per dollar capital invested into your company, right? So change in revenue by sales to capital. And once you do it for a subsequent period of time, you get that reinvestment rate. And that reinvestment rate can be subtracted from your operating income and you get your FCFF because this has already taken into consideration your capex working capital changes. So people tend to argue a company has a negative retention ratio. The company has maybe a lower amount of profit, right? Or the free cash flows of the company are declining, right? The company has like negative free cash flows in later years, right? Or the company is a startup company, a new age company, how to calculate their cash flows. But the only basic premise is the company should be profitable. So just subtract for reinvestment from the operating income. That is your change in revenue by the sales to capital ratio. And you get your FCFF. Simple way, right? This is one way to calculate. Other way that you use is something you take into consideration your net capex plus your change in working capital and you divide it by your EBIT into 1 minus tax. One popular way. It's used to calculate your reinvestment, right? How much reinvestment the company has made. So all these notes I have, all these notes I'm happy to share it with you, right? Because I generally maintain a booklet of all these things, right? Because if you have to implement it practically in the real world, you need to have your notes with you, right? Practical implementation will make you much more confident because I am using it in my day-to-day life, right? The one common method to calculate the reinvestment rate for net capex plus changes in working capital dividing by EBIT into 1 minus tax, right? So that is one way. One way is something which is called as an efficient growth rate. It has been used, started to use very recently, an efficient growth rate. So what do they do in this efficient growth rate? They tend to calculate the return on capital, right? In the T plus 1 year into the reinvestment rate, the return on capital in a T plus 1 year, right, into the reinvestment rate plus the return on capital in the T plus 1 year minus the return on capital in the T year divided by the return of capital in the T year. For example, if you're doing it for 2025, right, then the return on capital in 2025 into the return on investment of 2025 plus in brackets the return on capital of 2025 minus the return on capital of 2024 by 2024. This is called the efficient growth rate method. Sometimes the thing is people have also started something as earnings from non-cash, right? Again, it is not very popularly used, but people have started to use it, right? So that is one thing. So tend to take out earnings from all the non-cash assets, right? That's again a method. I would say not many people are using it, right? So that is ideally we'll tend to call it as expected growth from non-cash assets, right? The formula remains the same. Just to tend to remove the cash assets. All the cash yielding assets you tend to remove from your total calculation. I'll go toward the calculation in some later point of time. But then overall, because I'm keeping it session as an overall perspective, that is one thing. Because some people also tend to take into consideration the EPS growth rate, like how much growth rate the EPS has grown. Because there's always an assumption. So what's an assumption of earnings per share? It assumes that the reinvested earnings, so like whatever the company has made, all the money is being reinvested and earning that ROE. All the money is getting reinvested and earning that ROE, which might not always be there. And that is why they tend to use some other method of cash or the growth rate from the non-cash assets. And that is why it's the philosophy being used, because not all the earnings would be reinvested and not all the earnings would be giving you ROE, right? So that's for today. Okay, guys, thank you so much. And feel free to get back to me for any concerns or questions. Thank you so much.